Let me guess, you're Canadian and you're looking for ways to save and invest your money so that you can buy your first home. If that sounds like you, then you're in the right place, because in this video, we're breaking down the newest registered investment account that's offered in Canada, the First Home Savings Account, or FHSA. You might have heard of the TFSA, our RSP, our ESP, or our DSP before. Well, now there's a new acronym to add to the list. The FHSA was first introduced by the Canadian government last year, and it just came into effect the other week in April 2023. Now, the main purpose of this account is to help Canadians save for their first home. And by the end of this video, you're gonna know everything there is to know about the First Home Savings Account and how it works. Now, you might have already noticed that I've been using the words saving and investing kind of interchangeably. And that's because even though the FHSA has savings in the title and you could use it to save, it's actually a registered investment account. Now, typically when you invest your money, you have to pay taxes on all the money that you gained, but there are a few different registered investment accounts that exist that give you tax benefits. The classic one is a tax-free account, like the TFSA in Canada. When you invest in this account, your money grows tax-free. So when you take money out of it, you don't have to pay taxes on that money. There's also tax-deferred accounts, like the RRSP. When you invest in this account, you do pay taxes on the money you earn in the future, but you're able to lower the amount that you pay in taxes each year that you add money into the account. So the TFSA means less tax in the future, and the RRSP means less tax now. And because these are such great perks, there's actually a limit to how much you can contribute to both of these accounts. The FHSA is the newest account with tax benefits, and it kind of combines the perk from the TFSA and RRSP. The money you contribute to this account can be used to reduce your taxable income, just like the RRSP. And your money's also growing tax-free, just like the TFSA. But the catch is that when you go to take money out of the account, you have to use it to buy a home to take advantage of that perk. Let me break that down a little bit more. Picture the FHSA as an empty box. When you add money into the account, it brings down your current taxable income, aka the money that you make from your job. So if you add in $5,000 this year and you have a salary of $55,000, that means that it would bring down your taxable income from $55,000 to $50,000. So basically you'd be paying less money in taxes this year. Now let's jump into the future. Let's say that it's 5 years from now and you're looking to buy your first home. Let's also say that you have $30,000 in the account and you pull all of that money out to use for your down payment. When you take the $30,000 out of the account, you don't have to pay taxes on that money. So if your salary was still $55,000, and in reality, we would have hoped it would have grown a little bit over those 5 years, but we'll keep it simple for this example, your current taxable income at that time would still be $55,000, not $85,000. Okay, so you know how I said it's only tax-free if you take the money out to buy your first home? If you want to take the money out, but you don't use it to buy a house, then you actually would have to pay taxes on the money that you earned. So the benefits here truly are the ability to bring down your taxable income in the year that you contribute money, and also the ability to take out the money that you earned tax-free to buy your first home.
Okay, so now let's talk about who can actually open up an FHSA. So you have to be a Canadian resident, you have to be between the ages of 18 and 71, and you have to be a first-time home buyer. And based on the criteria, it means that you can't have owned a home over the past 4 years. This is kind of interesting because it's literally called the First Home Savings Account, but really it's your first home or your first home in 4 years. And to do that calculation, it's specifically that you can't have lived in a home that you own the year that you open your FHSA or 4 years prior to that. Now, I have to go back to that age range for a second because there's actually a little star right next to that range. So you can actually only have your FHSA open for up to 15 years after the year that you open the account. So if you're like me and you're 27 years old, you have up until you're 42 years old to use that money that's in the account to buy a qualifying home. So basically the FHSA can remain open for up to 15 years or until the end of the year that you turn 71, whichever comes first. Now, if you either don't use the money within your FHSA to buy a home within 15 years or by the time you turn 71, well, then you got a few options, right? So like we said before, you wouldn't be able to take the money out and not pay taxes on it, so tax-free, but you could take the money out and actually pay taxes on it. But the better option, or the better option, would be for you to transfer that money into your RRSP or an RIF, which is a registered retirement income fund, on a tax-deferred basis. Again, this would continue to reduce your taxable income because you'd be adding money into your RRSP account, which is the benefit of that account. So good news is that if you didn't actually use the money to buy a home, you wouldn't lose that money, but you'd be taking advantage of the most benefits if you did actually use the money to buy a house. Now, beyond that, there's a few more rules that you need to know.
One of those rules is that just like the TFSA and RRSP, the FHSA has a contribution limit. That means that there's a maximum amount of money that you can put into this account to again kind of limit the benefit to a certain threshold. Now, the lifetime contribution limit for this account is $40,000. So that means that the maximum amount of money that you can put in is $40,000. Now, your money could grow on top of this, and we'll talk a little bit more about that in a second, but that's the maximum amount that you can put in yourself. Apparently, the government landed on $40,000 as the magic number because it's supposed to represent about 5 to 6% of the average home price in Canada. And the lowest down payment that you can make on a home that's under $1 million is 5%. So in theory, you're able to use this account to save for a down payment for your first home. According to their research, the average home price in Canada is $736,000. Now, 5.5% of that is about $40,480. Now, if you live in a higher cost of living area, then you know that house prices can get a lot higher than that, but more on that in a second too. So the total lifetime limit is $40,000, but there's also rules on how much you can contribute per year. On a yearly basis, you can fund the account with up to $8,000, and any unused portions of that limit will carry forward up to a maximum of $8,000 to use the following year. Now, here's two different examples of how that could look. Let's say that I open up an FHSA in 2023 and I contribute the full $8,000. Then I do that again in 2024, 2025, 2026, and 2027. At the end of that 5th year, I would have contributed $8,000 per year, and I would have reached my total maximum limit of $40,000. At that time, I could either withdraw my money to buy my first home, or I could let my money sit there for up to another 10 years, so let's say until 2037, before buying a home to take advantage of the growth my money could see over that time period. Now, as a quick aside, the problem with letting your money grow is that home prices grow pretty quickly in Canada. So your money could be growing, but at a slower pace than home prices are going up, and you can end up actually losing out. So that's something to consider. Okay, so that was example 1. For example 2, let's say in 2023, you opened an FHSA, but you only contributed $3,000. Then in 2024, you contributed $13,000. The new full $8,000 yearly limit that you get, plus the $5,000 that you didn't use from the year before that. Now in 2025, let's say that you actually didn't contribute any money at all. And then in 2026, you contribute $16,000. Again, the new $8,000 yearly limit that you get, plus the entire $8,000 that you didn't use the year before. Okay, but as an alternative to that, let's actually say what happens if you didn't invest any money in 2025 or in 2026. What that means is that in 2027, you could still only invest a maximum of $16,000, which would be that year's $8,000 limit and an $8,000 from the year before, but you wouldn't be able to invest $24,000 even though you skipped 2 years.
Okay, so let's talk about withdrawing money from your first home savings account. So let's say you open one up, there's money in there, and now you want to take it out to buy your first home. So kind of like what we keep reiterating and keep saying, it has to be for either your first home or for your first home in 4 years. So in addition to this, what this means is that it has to be for your primary residence, meaning that you have to be planning on living there. Basically, this means that you can't use your FHSA to buy an investment property. It has to be a home that you plan on living in, and you have to move in within 1 year of the purchase date. Now, the reason behind this is because this account was actually intended to help Canadians be able to afford homes that they otherwise wouldn't be able to afford, not to help people make more money by investing in homes. Now, when you actually go to withdraw the money, there's a few steps you'll have to take. So you'll have to fill out a form called Form RC275, aka request to make a qualifying withdrawal from your FHSA. And once you have that, you'll have to give that to your bank or financial institution that you have your FHSA at. You'll also have to prove that you've written an agreement to buy or build the home within 1 year of the withdrawal date, and you can't have acquired the home more than 30 days before taking the money out. So basically what you'll do is you'll go get your written agreement, you'll take the money out within 30 days, and then you'll ensure that you move in within 1 year. Finally, after using your FHSA, you have to close the account down on or before December 31st of the year following you taking the money out of your account. And you also can't open up another FHSA in the future if you've already used one to successfully buy a home. Now, what you can do is you can have multiple FHSAs open at the same time. You just have to make sure that the total contribution limit adds up across all of your multiple accounts. Let's have Steph explain that further.
Okay, so you know how before I was mentioning how your money could grow on top of the max $40,000 that you can add in there yourself? That's because you can, and ideally will, use your FHSA to invest. One of the benefits of an account like this is that you can actually invest your money, have it grow, and then all of the additional extra money that you have from just investing it instead of letting it sit there is now brand new tax-free money for you. Think of your FHSA as a basket. The account itself just sits there. And if you put money in the basket, then the money just sits there too. But you can actually use your money to buy investments and then put those investments in the basket. Now, when you do this, your money is actually growing and it's still being protected by the basket itself. Something that I want to mention here is that for your other registered accounts, like your TFSA and your RRSP, we recommend using those for long-term investing, like for retirement. Because you have decades to keep your money invested, it means that you also have time to ride the ups and downs of the market. And ideally, you're going to get that strong average annual return over the long term. Now, with your FHSA, you only are for sure using that money within 15 years and potentially even within 5 years. So it's a much shorter time horizon. Because of that, you don't want to be too risky with your money, because you definitely don't want to be in a position where you go to buy a house and your money has gone down instead of up. But you also want to be taking advantage of investing and growing your money. So what are your options? There's a few different things that you can do, and we're going to go over this in more detail in the future, but at a high level, you could invest in passive index funds or ETFs that are well diversified specifically, and you could even look at investment options like GICs that have a locked-in return. Now, with an investment option like this, you might not be getting as much money as you could with other investment options, but you're also guaranteed not to lose money over a specific period of time. Again, we're going to have a future video coming soon where we go over all your options, but this is definitely something to keep in mind. With all of this, because you're investing your money, you could in theory open up 2 different FHSAs. Let's say, just for example's sake, you do that and you use one for GICs and one for ETFs. If you do that, make sure that if you contribute, let's say $25,000 to one, you don't contribute more than $15,000 to the other, to make sure that you're not crossing that overall lifetime limit of $40,000. And also keep the yearly limits in mind too.
Okay, so real quick, let's talk about whether using this account is actually worth it. Now, to no surprise, this account doesn't completely solve all the housing problems that we have here in Canada. Now, we've actually seen some people say that they're underwhelmed by the solution itself, and kind of like what we were talking about earlier, the maximum amount that you can actually save within the account just barely covers the minimum down payment across many different housing markets in Canada, and it wouldn't cover at all, really, the minimum down payment for a house in Toronto or Vancouver. We agree that more needs to be done when it comes to housing supply and affordable housing options, and we're going to talk about that in a future video, but we wanted to make sure that we touched on it here as well. Now, one thing that I will say is that having another tax advantaged account is definitely something that you might want to take advantage of. There's also a whole comparison that can be done between the FHSA and the RRSP's first time homebuyers plan, and if you don't know what that is, basically you can take money out of your RRSP tax-free to be used for the purchase of a home, your first home. Now, basically the way it works is that you can take out up to $35,000. The only thing is that you have to recontribute that money within 15 years of taking it out. Now, basically this is because the RRSP, the actual purpose of it is intended for retirement, not buying your first home. In this video, we want to mention that you can use both accounts at the same time. So what that means is that you can use your RRSP plus your FHSA. So let's say 35,000 plus 40,000, so for a total of 75,000, all to be used for the purchase of your first home. Will a lot of people actually be able to use this? I don't know about that, but it's definitely something you can take advantage of.
The last thing that's really important for you to know is if and how your money is protected within an account like the FHSA. We're happy to be working with CDIC or the Canada Deposit Insurance Corporation on this video. If you haven't heard of them before, CDIC is a federal crown corporation that was created to insure bank deposits up to $100,000 per insured category at any of their member institutions. What's good to know is that their coverage is free and automatic, so you don't have to sign up to be protected. Basically, if your bank or federally regulated credit union were to fail, you don't have to do anything in order to have their protection. What's great is that even though the FHSA was just created, CDIC already provides coverage for this new account. As of April 1st, any eligible deposits in an FHSA is separately protected for up to $100,000 at each CDIC member institution. To make it really clear, they cover deposits in Canadian or foreign currency, GICs, or other term deposits, and they don't cover mutual funds, stocks or bonds, ETFs, or cryptocurrency. Also remember that they cover up to $100,000 in a total of 9 different categories, and the FHSA is just one of them. If you have any questions about CDIC's coverage of FHSAs, let us know.
If you want to hear more about all of the other Canadian investment accounts, make sure you check out this playlist next where we've literally covered all of them. And yeah, with that being said, y'all already know the vibes. We'll see you next week and let's go.